15 for 15. I'm your host, John Zalkin from RKW Residential. 15 for 15 is a new and exciting video series where we interview 15 influential real estate people for 15 minutes each, where we will get their perspective on what is happening in real estate during COVID-19. A little bit about RKW. RKW Residential is an award-winning third-party multifamily property management firm with over 20,000 multifamily units under management and a growing footprint spanning 6 states. RKW delivers expertise in multifamily management through its technology, marketing, and customer experience platforms. My guest today is Andrea Howard from JLL. Andrea serves as the managing director for JLL Charlotte. She has 20 years in the commercial real estate industry with over $5 billion of multifamily investment transaction experience, mostly in the southeastern United States. Prior experience with both public REITs, Summit Properties, and Camden Property Trust, as well as private owner and operator, Grubb Properties. Andrea, it is great to see you, and thank you for taking the time to join me on this episode for 15 for 15. I'm really excited to hear what you're seeing in the multifamily sector and to get your thoughts on how things are going. If you can, just briefly expand on your bio if you'd like. If not, let's jump right into some questions.
I think we can jump right in, John. I think that covered a lot of it, but really appreciate you having me on the program today, and hopefully I can answer some questions for you.
No, I wasn't lying when I said I was really excited to get you on because I know your level and where you're at in the multifamily and the transaction, especially in the Charlotte market, is at that high level. And as we were saying earlier, I'm glad I got you on now and not a little earlier because so much has happened from the beginning of COVID-19 till today. So just to touch on like a 30,000 foot level, what are you seeing? And then we'll just dig into each little thing and try to get some stuff out of this.
Yeah, sure. Well, first off, John, I just want to make sure you and your audience know that anything I say today is really informed by conversations that our platform and that our team specifically in the Southeast is having all day long, multiple buyers and owners and clients across the country. And so, in no way represents necessarily what I or JLL thinks, but I think will be helpful for you guys to kind of understand the perspective. I think overall, there's a mixed bag out there right now. Obviously, there's folks that for the first few weeks were playing exclusively defense. Very, very nervous about their portfolios. I think we've sort of gotten to the other side of that and now have a lot of folks playing both defense and offense and trying to figure out where the opportunity is going to be in this. Obviously, the debt markets have been incredibly volatile, and we've seen that actually calm down in the last week and see a little bit of return to normalcy in terms of where interest rates are and ability to actually get something financed. That is a key differentiator for the multifamily business right now. We have the agencies, and so we have a liquidity source. In fact, that's probably the most optimistic thing that I can share, that from a 30,000 foot perspective, when you compare this to the prior downturn, there's a tremendous amount of liquidity in the market, more than 2.5 times the amount of dry powder and capital that was sitting on the sidelines in the last downturn. So folks are gearing up and they're trying to figure out where the opportunity is going to be on the other side of this and how to underwrite that. I would say that's probably their number one question.
So in terms of talking to your clients, and I know everyone's looking for opportunity. I'm hearing from some of my clients, hey, 5% off of where we were before is an opportunity. And then I have other clients saying we're not looking to anything at 20% off. So is there like a consensus or a range of where you're seeing that people say is an opportunity?
Yeah, and I think the important distinction there is going to be what product class are you talking about? Because I think we've seen a difference of performance if we go to talk about collections and what we've seen from class A to B to C. Properties. And so I think it depends on absolutely what the product class is, but we are seeing a lot more strength in the A's. And so I think from an opportunity standpoint and how we're seeing folks price it, I think they feel definitely a little bit more optimistic about being able to underwrite the A's, the health of the A's, therefore they're going to be more aggressive there. And so we've seen pricing anywhere from 5 to 7%, I would say, off in the class A space. I would say the B's are more like 8 to 10 or 12%, and the C's are somewhere between 10 to 15% or so off. And we have call for offers we could talk through. I don't think we have time in this program, but we have live transactions in all of those categories. We're actually calling for offers on something later this week, 2 newer deals in Raleigh. And last week we actually saw a newer asset go hard, non-refundable on a deposit in North Charlotte. That was a newer asset, 2015 vintage. And that was a deal that actually got put together right in the midst of this COVID mess back in mid-March. We only ultimately saw a little under a 3% sort of retrade of the price that had to occur because their interest rate, cost of debt, ended up blowing out from the week that they went into the deal to when we signed it up with them, and they ended up putting up their deposit hard. So, I mean, that's probably an optimistic, that's a lower end of the range in terms of an impact on pricing. I would say the norm has been kind of 5 to 7%.
So we're hearing, or I've heard from some of my clients and from some people that I speak to on a regular basis, that some people are putting up reserves to put into an account to say, hey, here's X amount of dollars we'll leave up. And if the rents don't cover or the occupancy, they're able to draw it off of escrow. Are you guys seeing that creativeness coming to your area as well?
Yeah, absolutely. I mean, let's be clear, if you don't have to sell in this environment, most of our sellers are generally on the sidelines. But to the extent someone has got a motivation to sell, we're seeing escrows set up not only on the operations side, as you said, in case of collection shortfall. We also are seeing it happen from a due diligence standpoint. You know, we're obviously not able to walk occupied units right now. So, you know, we've had a lot of buyers say to us, I'm nervous to offer on your property because how am I going to logistically do due diligence? There are ways around that. There are third parties that are local that are able to go. The lenders have been very flexible and have allowed you know, only the vacants to be walked. And to the extent an occupied can get walked prior to close, then you wouldn't get credit for that in an escrow. But a lot of groups are setting up escrows, call it $500 to $750 a unit, that would be there when and if they get into those units post closing. So I think there's a lot of creativity happening, and those are the groups that are going to find opportunities sooner.
So I want to shift gears for 1 second to, I was on a panel with one of your JLL colleagues down here in Miami earlier in the week, and he was sharing a lot of the JLL data. You guys have done an amazing job collecting data on rent collections and where it is. As of today, well, it was funny. When I first started these podcasts, it was, what's April going to be? And we grew through April, and everyone was like, wow, this was great. Now, majority of the people, obviously, RKW deals mostly in A-class assets. So the majority of the people I've spoken to are there. Some of my C-class asset friends, they aren't as fortunate. Some of them are feeling some real pain. But on the A-class, or just give us like an overview of what you guys see as of today.
Yeah, I've been very fortunate to be part of this platform. You know, JLL and HFF merged last summer. And so the combined platform, the leadership, the communication that we're having across the platform has been really helpful, allowed us to share bird's eye view with our clients real time. And the idea of the collection portal was a great idea by our leadership. We've got almost 1 million units that are now in there and a range of product from A to B to C. And so I've got the numbers in front of me. Overall, across the country, the A's are about 93%. The B's collected about 91% of March, and the Class C stuff was about 88%. And that was as of April 17th. So that's probably what you heard. Specifically in the Carolinas, we're somewhat in line with that, if not a little bit higher. The JLL data is actually 93% collected in Charlotte for the A's, and Raleigh is 94% for the A's. I've had anecdotal conversations with other owners, though, that they've got deals that are anywhere from 96 to even 100% collection. So the theme in the A's has been much, much stronger than the B stuff.
And your clients and the people you speak to on a regular basis, are they expecting May to come in line? And, you know, we're hearing, at least from some of our clients, but more or less people outside of the RKW world, other owners that I know, that they're saying May, and we're not sure, but we're more worried June, July, as stimulus runs out and unemployment stops being collected. Is that what your clients are saying as well?
Yeah, I would say it's 50-50. I think there are clients of ours, especially if they own more A product, that actually are very bullish on May. I think they feel very strong that profile wants to pay rent. They're figuring out ways to do it. The workforce space, though, I think everyone's a little bit concerned about. In some respects, they're making more today than they actually made 30 days ago in some cases. So I think it's going to really vary market to market. And one of the things that we're tracking across the country is the percent of service industry type jobs that are in a given market. So there seems to be a correlation so far. The secondary markets, for instance, did much better than the primary gateway cities in our collection data survey. And right now, I mean, we're glad in the Carolinas, at least, that we're a very low number of service-oriented jobs. Actually, out of the top 49 markets, Raleigh's ranked 48th out of 49, and Charlotte is actually ranked, I think, 44th out of 49. So we are very low in terms of percentage of service, meaning higher percentage of white collar. So I think the A's will probably fare better here than the A's may in a New York City, for example.
Yeah, I think down here, Miami, I think besides Vegas, I think Miami was like number one, it was 2 or 3, and same thing with Fort Lauderdale. And you can see in the rent collections, but in a lot of our properties, we still had strong rent collections as well. I think April, I think May will be telling, but from my conversations with a lot of people seem just as bullish as there. Switch back gears for a sec, put your crystal ball, put your hat on, and when do you think the transaction market returns back to, I don't want to say normal because I don't, we're in, a post-COVID world of everything's going to be normal, but when do you start seeing, as I said early on, like my inbox was nowhere near as full with call to offers and this deal's coming out. And so I'm like, at first I was like, oh, it's nice. I don't have to like put things here and there. And now I like kind of miss it. It's like, you miss what you don't have. So when do you think that will start?
It's funny, John, we were having that debate actually this morning, me and my partners. We are continually being asked to value assets and pitch assets and give that sort of advice. It's tough. It's really tough to gauge that sitting here today without at least some of the economy starting to open. But clearly we're going to have things at least starting to try to get to a new normal in terms of starting to open back up before we can really have any conviction around the underwriting. But I can tell you what we've been doing is running underwriting scenarios that give them a benchmark of where it would have been kind of pre-virus. And then we're looking at 2 scenarios. One is more of a V-shaped recovery. One would be more of a U-shaped recovery. The V-shape would obviously hopefully get us back to an environment that we could at least underwrite some rent growth returning in 2021. But probably things staying flat for most of 2020. I think the U-shape means probably flat, NOIs and rent growth for most of this year and next year. And so when do we return to normal? I think there's going to be a new normal, unfortunately. That's my personal view. And I think this probably drags out. And so I think there's going to be opportunity depending on the asset class and depending on the deal. And so what could be a normal price and a good time for someone to sell for a Class A deal or something coming out of lease up could happen as soon as later this year. I mean, we're fairly bullish that if deals continue the lease up pace that we're seeing very strong lease up paces, and some deals in particular that are being propped up by demand in RTP and all the pharma companies that are hiring, demand at the hospitals at Duke and UNC Chapel Hill right now. So we're tracking some very strong lease ups. If that continues, you could see a normal underwriting and a normal pricing of that asset as early as August or September. And so I do think there will be deals that get taken out, and there'll be some normalcy, if you will. I think there'll be adjusted underwriting, but an ability to price something in a new normal. And then I think there'll be other asset classes that it's going to be easily into next year before we kind of get back to a normal and an ability to price those assets.
Yeah, I couldn't agree more. We've had some pretty strong lease-ups numbers, relatively speaking. Before we and I got on this, I was on a call with one of our clients, and 4 to 6 leases in a week, which during good times was strong. There's a lot of people that are trying to move and get things going now, where the first couple of weeks they weren't. And so look, I love optimism, and I hope we can revisit this, because I tell almost everybody I want to bring you back in a few more weeks just to really gauge how things have transacted from here. And I can't thank you enough for coming on. And you ready for your lightning round questions? We're gonna do a few fun questions.
Sure. We're already ready for that. Okay.
I told you, 15 minutes flies when you're having fun, right? All right, you ready? So we're going to ask you a few questions, over, under, yes or no's. Does the 10-year Treasury close over or under 1% by the end of the year?
Under. I think rates stay low for a while. I think that's the general consensus by our clients too.
Next time you're on an airplane, over, under 90 days?
I think over. I can drive to most of my properties.
Next time you attend a networking event, over, under 90 days?
Over.
Next lunch or dinner at a restaurant with a client, over, under 90 days?
Hopefully under. I miss my clients.
Will Trump win or lose?
Oh, that's a tough one. I'm going to say it's a lot more in question now. I'm going to say 50-50. He's got some work to do. I do think it'll be less of a disruption if he doesn't win than I think everyone was worried about 6 months ago. So
I'll let you punt that one. Does the stock market end over or under 20,000 by the end of the year?
I think we're over.
And do you think you will be on a vacation the next 6 months?
Absolutely. Will I be driving or flying is the question.
Right. I should ask, will you be flying on a vacation?
I will not be. I will probably not be flying. Just we have a lot to see in the greater United States and the Southeast. So.
Sure, Andrew. I really want to thank you for joining me today in this episode. That was a lot of fun.
Thanks so much, John. Really appreciate it.
So everyone, we hope you all stay safe and practice social distancing and make sure to wash your hands. If you have any questions or would like to find this video, please visit rkwresidential.com.